Hi, welcome to this week's edition of the Groundfloor Market Trends podcast. Today is August 15th, 2024. I'm your host, Patrick Donahue, and today we're going to review Groundfloor's July performance as published on our asset management blog. We're going to touch on some of the housing news and start looking ahead to what's on the horizon for September and beyond in the fall season and towards the year end. So let's start with Groundfloor's July performance. You can check this out on our asset management blog. You can go to our website, groundfloor.com, and head towards the blog section. And you can read along with the blog or just read it in your own spare time. The blog is produced by our asset management department, led by my friend and colleague, Reed Shermer. So let's get through the blog. So in July, the summary here, total loans repaid 92, repayment volume 22.6 million, very strong showing, with a rate of return on those loans repaid in July of 11.47%. The total active loans are 1,265. In July, the loss rate of the loans repaid was 1%. Groundfloor had 92 loan repayments, which is about 10% of the overall volume this year. There's been 961 loans repaid over the last 12 months. 22 million is a very strong showing. This year, or the last 12 months high, was 25 million with a low in September of 15 million. So in April, there was 25 million repaid, and the low was September of 15 million. So 22 million, 22.6 million actually, is above trend. So good work on everyone that brought those loans in, borrowers, our asset management group, underwriters, sales team, well done. We can see that the trend this year has been very consistent, averaging about 20 million a month in repayments, maybe a little bit less. That is a very consistent number for the amount of inactivity that's been present in the market. So the market's been very sluggish this year, as we know, but the repayments have been what I note to be very consistent all around. So amount of interest repaid, 2.5 million. That is actually the second best month of the previous 12. The best month was April, 2.6 million. So this month was right on its heels at 2.58 million. We saw a low back in September of 1.4 million, but generally we've had very consistent repayment numbers this year, especially over the last 12 months. The rate of return, 11.47%, was a 12-month high, and a loss ratio of 1%, was certainly below the peak in March of 2.5%, and back in last December of 2%. So 1% below trend, that's what we like to see. Higher than trend interest, higher than trend volume repayment, lower than trend loss ratio. So if we note and break down the numbers of those repayments, of the 92, we saw that 57% came from the current loan book, meaning 57% of the loans repaid were current, which means at or before maturity. 31% came from the extended book, which is borrowers need more time to complete the project or sell the project and sell or refinance the project. So that 31% of the 92 loans repaid came out of the extended book. And then the default book, 11%. So 11% of the loans repaid in July were loans paid out of the default side. So relative to numbers, that's 56 current, 27 extended, and 9 from default. Two highlights this month, really interesting cases. If you look at the repayment of 9 West Walnut. This loan was matured way back in March of 2020, which was the onset of COVID. So COVID caused significant delays. There was a foreclosure moratorium that we had to work through. The foreclosure was eventually filed in 2021, and the property reverted back to Groundfloor in 2023. Of course, there were squatters in the property when we got it. We had to evict the squatters. That eviction was completed in April of 2024. So wow, loan matured in March of 2020, right at the onset of COVID, dealt with the statewide foreclosure moratoriums, had to go through the foreclosure itself, had to evict the squatter, or squatters. That eviction was completed in April of 2024. At that point, the property was cleaned and readied for sale. In that sale on the REO market, that REO transaction resulted in a sale that brought investors back principal plus interest. So good job there. And then on 2571 Sharondale, this loan matured in November of 2023. There were several construction delays. A workout was given to the borrower so they could continue the construction post maturity. But eventually a foreclosure was filed in 2024 after sort of several delays. However, we stuck with it. Good communication with the borrower between the asset management group and the borrower, and the loan was actually successfully repaid in July of 2024 with full principal plus default interest for investors. So a good outcome for all. So that is July. To recap July, 92 loans were paid, 22.6 million in interest at a rate of return of 11.47% and a loss ratio of 1%. Very strong month overall. As we turn our attention to some broader housing news, I think it's generally easy to classify the market as supply is up and demand is down. Inventory is 41% higher than it was at this time last year, but we're still below pre-pandemic levels by a wide margin in most states. There are some states that are bucking that trend. Two of those are Florida and Texas. We're certainly watching those states, especially Florida, because of our existing loan book has loans in many of the Florida markets. Turning to Altos Research and what they have to say about inventory. Altos Research is one of the research firms that I pay attention to. I like their podcast. I subscribe to their data. We use their data in underwriting. We certainly are proponents of the work that they do there. But according to their research, they're forecasting that inventory will end 20% higher than it was in 2023. What does that mean? So that forecast basically suggests that inventory from this point towards the end of the year will subside. How do we know that? Well, we know that we're at 41% above where we were at this point last year in inventory currently, and the forecast is suggesting that we're going to end 20% higher than we were last year. So there's going to be a compression in inventory. Inventory numbers will decrease as we move towards the end of the year. Because of this, I'm fairly confident and definitely think that housing prices are not going to soften nationally as we close out the year. Likely home prices on a national basis will remain resilient, and in most of our markets, many of our markets, resilient throughout the rest of the year. In some markets, we definitely are seeing buyers markets emerge. We're watching that closely, but by and large, on a national level, if you look from a national perspective, prices should hold their current level. Months of supply is reasonable, generally under 3, generally under 2.5 in most of our major markets. And also mortgage rates are likely to stay at current levels or fall, most likely fall, as we progress towards the end of the year. Demand is likely going to meet supply, so thereby keeping prices from falling at any sort of concerning rate. Current mortgage rates are at the lowest point of the year. That is fantastic. I have 6.5%. You could see 6.6% depending on your source. My source is Optimal Blue if you want to compare notes. The majority of the time this year, mortgage rates have been higher than they are now. Thank you, Altus Research, for that. We are at the low point of rates for this year. So over the last 12, or actually since the beginning of the year, the mortgage rates now are generally at their lowest points. I do expect certainly an exciting interest rate market as we move forward. If interest rate markets can be exciting, this will be an exciting one. We're definitely seeing the equity markets clear through some of the turbulence that they've been experiencing over the last couple of weeks. This week has been a fairly strong result. We saw good consumer news this week. We saw good CPI news this week, and we actually saw good jobless claims data as well. So the data was generally positive this week. The yen carry trade, I guess, has been pointed out as a reason for some of the turbulence in the markets, but you definitely, by and large, saw markets course correct this week and see some favorable results. So that is it for now. Check the podcast out next week as we recap some inflation and employment metrics that are making headlines and moving markets. Stay tuned so we can bring you up to date to the most pertinent news in the housing and investing markets. I'm your host, Patrick Donahue. Thank you for joining this week and have a great week ahead.